Welcome, welcome, welcome. Everybody's trickling in here. I apologize, everybody. I was on the wrong Zoom link. Sitting there staring at a bunch of zeros in the participants, and that's my fault. I was in the wrong Zoom link. So I apologize. This is still new to me. I'm new to the webinar world, but we're going to be doing these lives every Wednesday. And thank you for joining. I see some familiar names. I think I see an architect friend that I used to know years ago, who is a very prominent architect for a very well-known firm in Detroit. It's good to see you, sir. If that is you, it's got to be you. Good to see you, man. In the chat box, what's up, Amir? Good to see you, my friend. Go ahead and type in where you're from. Let's see where everybody's coming from today. I have a nice little presentation planned. Not super long, probably 25 minutes. And South Carolina, what's up? Colorado, what's up? Probably 25, 30 minutes, depending on questions. If somebody has questions and wants to go into detail a little bit more. What a crazy week we've had. Not much new in the news, pretty typical week. Nothing else, nothing really going on. Nothing that would affect the economy in any way, other than we have seen the leader of the free world once in the last 7 days, and he resigns with a letter that looks like a forged signature that's not on White House letterhead. And then he stumbles his way to a plane. Nothing to see. Nothing to see here. But I think we have a new candidate for the Democratic Party. I don't think that it was voted in, but there's a new candidate for the Democrat Party. So whether you wanted to or not, I think you have the person running in place. So it's going to be an interesting time. Who knows what the markets will do? Part of the reason I love what I do is that my clients are not subject to market volatility. I don't have to apologize about the market changing, because here's the only thing that I know to be true. The market will be different tomorrow than it is today. Whether it goes up or down, it'll be different. And if it goes up, you watch financial planners say, look at how good I am. If it goes down, you see people apologizing to their clients and say, don't worry, you're in it for the long run. But the long run will run out. Not everybody wants to be traveling to Dubai, in their 70s to work. Do you hear me? At some point, you want to slow down, and you don't want the market to take away all of your savings and your retirement income. I'm not here to talk about retirement income. I'm here to talk about some simple strategies that I think people can put in place to allow them to get ahead in life without taking too much risk. So I'm going to share my screen. Thank you, everybody. We got an architect from Detroit. Look at that, downtown Detroit. Yes, Detroit, not a suburb of Detroit. That is in Detroit, his office. I've been there. It's beautiful. Gosh, what building was that in? It was right by where Lawrence Tech was. Robert, what building are you guys in? Are you still in that same one? Fisher Building. The Fisher Building. Beautiful. I think that's an Art Deco building. Yeah, it is. It's beautiful inside. It's all Art Deco. A friend of mine was friends with Andrew Fisher, who passed away a few years ago. Tough life. I can't imagine being born into that much wealth with generations before you that were so successful. That kid had a lot of weight on his shoulders, and unfortunately, he passed away. So, all right, everybody, I'm going to share my screen. Today, let me talk about this. We're talking about money. We're talking about financial decisions that we can make today, maximize our rate of return, minimize risk. And let's look at the way we're taught to view money. We are taught to have these segmented columns or areas to save. We have a short-term savings, which we might use a bank. You have a mid-term savings, which might be some sort of mutual fund. And then we have long-term savings, which would be like a retirement account, because you're not going to use the money for a long time. And this segmented version of placing our dollars into these specific coffers for specific uses essentially is hurting your ability to actually create wealth. Money needs to be in motion. Saved money is losing value. Hopefully the market goes up, but inflation is killing the value of the dollar. So how can we get ahead? And it starts with simple everyday decisions. So let me share my screen. If anybody has any questions, or if you want to make sure that I cover something, go ahead and put it in that chat box. Share this iPad so I can draw. I'm an architect at heart, Robert. What can I say? I like to draw. I'm going to share this. Oh no, guys, I'm going to pause this really quick. It's not plugged in. Give me 2 seconds. I'm here. Just got to plug something in. I'm not leaving. The cord was unplugged. All right, plugged in. Try it again. There we go. We're live. We're up. We're good. All right. Financial decisions. We've been taught to segment financial decisions. Hit my camera. All right. We're diving in. Everybody on the call can initiate what I'm going to teach today. Very simple. Let's talk about what we typically do. As we earn income, where does that money typically go first? When you get a paycheck, that money typically, we don't even see the dollars anymore. Who here has held cash in the last few years? Not very often. The money is directly deposited into a bank. Okay. What's the rate of return inside of a bank? Typically, it's very low. If you get sued, the money is exposed in a lawsuit. And we have very little benefits from keeping it there. Other than if you have a significant amount of money in a savings account, the teller, if you ever go into the bank, which I don't even know if anybody does this anymore, the teller will pull you aside and say, look, Mr. Love, we notice a large portion of cash in your account. Why don't you come and talk to our financial specialist so you can decide what to do with that money? And then you're going to talk to a mediocre level employee about what to do with a lot of money. It's the only time that they call you. Hey, you have cash? Let's go sell you a widget. Not interested. So the bank became this popular place to store our cash. And what does the bank do with their money? They lend it out. But what are we taught to do with our money? Pay for everything with cash. Don't go into debt. It's the exact opposite of what banks do with their dollars. So when it comes down to it, there's only a few things we can do with our money. I can spend it on lifestyle. I can give it away to a charity, or I can save or invest. But I can only do those things after the money goes inside the bank, right? I have to take receipt of the cash. The IRS is going to get their fair share, and then I can do something with that money. Okay. Now let's back up a second here. I'm sure everybody on the call right now has a car. Put a Y inside the chat box if you have a loan. Put an L. Put an L inside this chat box if you have a loan when you bought to purchase your car. Car loan. It's super popular. I have a car loan. I think it's differently structured, but we have a car loan. So what does that mean? So let's say this is my bank account, and this account has zero money in it. So this is my zero line. Well, when I take a loan, essentially what I'm doing is I'm going to the bank and saying, hey, look, I want to go into debt. I immediately want to take on debt at an interest rate that who decides? You or the bank? Who decides the loan rate? And if you want a little secret, the best way to get a low interest rate on a loan is to prove you don't need one. Well, chances are when you bought the car was collateral. Okay, so it's not a very good asset because it depreciates over time. So they're going to give you probably a fairly high interest rate. And that interest rate is much higher today than it was 3 years ago because of the economy. So what happens is over time, you start making payments back to this loan. And after 4 or 5 years, the car's paid off, but the car is also 4 or 5 years older. It's not the same car it was back in the day. And our logic says, look, the car, it's getting old, probably going to need some repairs soon, and I don't really want to deal with the maintenance. I've already budgeted the payment amount. Why don't I go back and trade the car in? So I lose the car because I traded in, and I'll just buy another car, and I'll go into debt again. This is what Dave Ramsey has built a career on, teaching people that this is bad. And he's right. Going into debt for consumer goods that are depreciating liabilities is not a good way to borrow money. It's not a good purpose to borrow money, but we do it every day because it's popular. Because what's the alternative? The alternative is I save enough money to go buy a car. So let's say that I have zero money in this account, and instead of going into debt and buying this car, what if I postpone the purchase? What if I just put money into that account so that at some point I had enough money in the account, I can just pay cash for the car? So I don't have to get a loan. I just go to my bank account and say, hey, I want to take out 30 grand, 40 grand, whatever it is, and go buy the car. What happens to my bank account? Zero. I'm right back to square one. Now, look, maybe you don't go to zero. Gosh, I doubt anybody on this call has actually gone to zero. But, if you save money and then spend cash to buy the car, essentially, you have just lost a significant portion of cash to buy a liability that's going to also depreciate over time. This is where Dave Ramsey says, pay cash for everything. You'll be better off. I would argue other people's money is pretty valuable because that's the exact opposite that a bank does. A bank is lending money constantly. See, the problem with spending cash is not the actual purchase of the vehicle. It's the lost growth that money could have earned me. And over time, it's a very drastic number. So the younger people on this call, your opportunity cost, that's called opportunity cost, your opportunity cost is substantially higher because you have time on your side. And the sooner you understand this, the sooner you can recapture all of the opportunity cost. Give me a Y in that chat box if that makes sense. If you have a question, hit me with the question, because I want to go on to a different topic here, but I'm going to come back to this. Because this is where most people are losing money in everyday transactions. So we just went over a car. What does it take to buy a car? Does it take a loan to buy a car? Nope. Does it take gold bars to buy a car? Could you go buy a car with gold bars? Go like this. The dealership can't deposit gold bars. Francilia, you're right. It's cash. You need money. All right. You need money to go make a car purchase. What does it take to buy a house? Can you buy a house with cash? I was going to say Bitcoin, but soon we will be able to buy houses with Bitcoin. You need money. What do I need to buy a rental property, a rental house? I need money. What about if I have 3 daughters and I'm accepting donations now for their weddings. We have a little bit of time, I hope. But what do I need to pay for a wedding? Cash. I don't need a savings account. I don't need a retirement account. I don't need gold bars. I need cash. What do I need for retirement? Cash. You don't need a retirement plan to retire. You don't need a savings account to go make a purchase. You don't need a 529 plan to send your kids to school. You need cash to make these purchases. And the financial industry has done a really good job of segmenting these decisions into widgets. And then they name them 401k for retirement, IRA, SEP IRA, 529 plan for colleges. They have these widgets that they can promote for these events that you don't even know if you're going to get to. And at the end of the day, you just need money. Well, what if we could recapture all of the money that we're losing through everyday purchases like buying cars? What if we could recapture this opportunity cost? That's what I want to talk about. Income via cash. And Fran knows a lot about what she's doing. She's got income coming from multiple directions, not just a paycheck. That's called redundancy. Fran, I'm reminded of that t-shirt. It says Department of Redundancy Department. I should get you one of those. Okay, let's talk about a house really quick. In order to buy a house, typically, you're going to need a down payment. So you got to put cash into this thing on your own. And the rest is debt. You get a mortgage. Now, mortgages are much different than a car loan, but I think this is a really good example of how to set yourself up to succeed by understanding how to leverage other people's money. Okay? When I buy a house, I have to put in the down payment. So Tyler, for a first-time home buyer, you don't have to put quite as much down. It's as little as zero, depending on your background, if you're a veteran and whatnot, but sometimes you can get away with 5 to 10%. Typically, people are going to have to put down around 20 to 30% down on a purchase of a property. Okay, that's the cash that's required. And the rest comes from a lender, and it's called a mortgage. Trick question. Does the mortgage affect the value of the home? Give me an answer in here. Does the mortgage, whether or not you have a mortgage or not, does it affect the value of a home? Amir, correct. Fran, correct. It doesn't. The fact that there's a loan has nothing to do with the market value. The market determines the value of the home. The mortgage has nothing to do with it. The loan rate to get the mortgage. That's where the financial entertainers say, you don't want to pay this interest because over time it'll cost you, twice the purchase price of the home. They're not wrong. If we have time, I'll go into debt and inflation, because that's an easy concept to understand, but that's not the purpose of today. So let's say then that I go buy a house, and if I follow the financial entertainer's guide, I'm going to be making extra payments. Let me go over some definitions. The mortgage is called your debt. Your debt payments is called your debt service. So that when you hear that debt service, that's like what's due on a monthly basis. This green portion is called equity. And I think I saw my boy Jay on here. Jay knows what equity is. Yep, Jay, you know what equity is. I see you, buddy. The more payments that I put into the house, the more equity that I get. So over time, I can get rid of some of that debt, and I'm just building more and more equity. And the debt gets smaller. Now, what can I do with the equity? Follow me on this. Equity needs a word in front of it. And I say it's dead. It's dead equity. It doesn't do anything for me. Now, in retirement, it might be good to have a lot of equity because you don't have that debt service. For a rental property, if you don't have that debt service, you can keep more of the cash flow. But for someone who's building wealth, that equity is dead equity. It's not helping me. In fact, it's probably not even your equity. The only way to get to the equity, there's 2 ways to get the equity out of the house. Number 1, you sell the house, which I'm not a fan of. I've done this in the past. Jay used to go to my cottage up in northern Michigan. My goodness, I wish I still owned that. Property on the water with the house, 3-bedroom cottage for $150,000. I sold it. Dumbest decision ever. Don't sell. So, and one way to capture the equity is sell the house. Then you have taxes and all this. And what did you lose? The biggest asset. You just killed the goose that was laying the golden egg. So don't sell. So then they go, well, you know what? You can go to a lender and open a HELOC. In the chat box, what does HELOC stand for? Home equity line of credit. You got it. I can open a home equity line of credit. Now, when you get the money from a home equity line of credit, you're going to go to the bank. They're going to give you a $500,000 line of credit. Is that your money? Want proof? Capital letters. Fran, you know what I'm talking about. If you want proof, go ask the lender when you take the money, hey, do you want this back? Yes, they're going to want it back. In fact, they're going to want monthly payments. And what happens if you don't make the payments on time? Foreclosure. What do you have to prove in order to get the home equity line of credit? Income. They have to go through your credit. They're going to report on your credit score. It affects your ability to get future loans. And how often do they want to be repaid? Monthly. Look, I love the idea. Home equity lines of credits are great. I have one. Guess what I'm paying? Holy smokes, that's not fun. Lines of credit have a floating rate that can go through the roof. But I can pay that back, but I can use the equity now for something else. Okay? So here's what happens. Remember this conversation up here, my zero line. Either I borrow somebody else's money or I save my money and spend cash. There's a third option. Here's my line, my zero line. Theoretically, let's say a house compounds and goes up in value. If I use my line of credit and borrow against the house and take out, I don't know, $100,000 to go buy a rental property in Alabama on the ocean, because as many of you know, my thesis for real estate is that in 30 years, I think people are going to want to sleep inside. So I think real estate is going to be a good place to put some money. So I use the equity of my home to go buy a cash flowing asset on the beach. Does it affect the value of my home when I take out this line of credit? No. Why? Because I borrowed against the asset versus taking from. And when you start to understand this, you're going to realize how to maximize retirement income too, borrowing against assets rather than taking from. Here's a great way to look at this. If I have my house, I have $500,000 of equity, I could get a HELOC and borrow against the asset, doesn't affect the value. But let's say I went in there and I took all the windows off and I took all the doors off and the shutters and I sold all of that. Does that affect the value of my house? Yes, because I'm taking from the asset. See the difference? From versus against. I want to borrow against these assets. And there's not many assets you can borrow against. IRA, 401k, a lot of these places where they try to segment your money, you can't use as collateral. And guess who loves that? The financial planning industry. They get to manage accounts pre-tax. So it's a false number because the IRS hasn't had their fair share. They get to manage those accounts knowing that you're not going to use the money because it's earmarked for retirement. Yeah, but I want a rental property now. Hopefully this is making sense. Give me a high five if you're liking this conversation. Nobody's left here, so this is good. So give me a high five if this is good. Sweet. High five. There we go. Double high five. So I use the $100,000 then to go buy a cash flowing asset. If I use my line of credit, I'm exposing myself to these risks. Years ago, literally almost a decade, I wrote this dumb book called Don't Be Debt Free and Broke. And it's all about how to leverage other people's money. And it goes over what defines good debt and what defines bad debt. And one of the things that defines good debt is a fixed is a fixed loan rate. We all make mistakes. I am eating. Thank you, Tyler. I am eating my own words. I got a HELOC buying my house because at the time it was a good deal. Rates went through the roof, and guess who's paying extra now? I violated my own principle. I got a loan on a floating rate. Here's the good news. The property is almost doubled in value. We're going to make a bunch of money, so it's good in the long run, but I violated my principle. So once I understand the principles, I know whether or not if I want to go outside those based on certain parameters. And at the time, we got a really good deal in the house. So I could justify that 100 ways. My daughter was born there. My wife loves it. It's a huge place. Jay's been there. It's a beautiful home. So it's not all that bad. Life is more than a rate of return. Never forget that. And an interest rate. Life is more than an interest rate. Okay, so once I understand how to leverage other people's money, I realize that a HELOC is a pretty good way to do it, other than all of these things in red. Okay. I would use a HELOC from now on as a second point, not the first. And as an architect, and Fran, you're right, HELOC is a tool. As an architect, I look at principles and wealth, just like principles with buildings. The foundation of a building is the most important. It's the stuff that cannot fail. If the foundation fails, I don't care what's above, it's all going to come crumbling down. So the foundation of my wealth, I'm going to go back up here, is understanding this one simple move. And that is replacing the bank. With life insurance. Because it's not just me making an income. I have a wife and I have 3 little turds that I take care of. So my biggest asset right now is my income, my ability to go earn for those little turds. If I'm gone, what happens to them? What would they get? My bank account, my 401k? Google how that works out when someone passes away. It's horrible. So I replace the bank with my life insurance. I buy a really big death benefit that will take care of my family. So I now have permission to go do these 3 things without taking away from the inheritance that I've set up. When my money goes into life insurance, I'm going to erase this stuff. When my money goes into life insurance, I have a guaranteed rate of return, which is typically much higher than what a bank would pay. Unless now you have a high yield savings account, which has come out in the last few years. Historically speaking, you're talking 200, 300, 400% higher rate of return than what a bank would pay inside of life insurance. Now your money has to be locked up in a bank in a high yield savings account, but that growth is taxable as ordinary income. That's a whole nother conversation. In life insurance, I have guaranteed growth. I can use it as collateral whenever I want. I have the death benefit. I have a waiver, which means if I get disabled and no longer can do this, the insurance company will fund the policy for me. So as someone whose biggest asset is income, that's my redundancy built in, my Department of Redundancy department. This does not offset Social Security and retirement. It does not offset college lending. My life insurance doesn't get exposed when I go to fill out a FAFSA form if my kids want to go to college, if I let them. If they go to school and I want to get a loan so that they can have some skin in the game, my cash value life insurance will not offset what they're able to get a loan for. My income might, but not my asset. Because of that, and that is because it's off the radar screen of any creditors. No one knows it exists. It's also off the radar screen of the IRS. All of that growth inside this little bucket of life insurance is off the radar screen of the IRS for income tax purposes. I don't owe any tax on the growth. Okay, here's the part. Let's bring it full circle here. As I fund my insurance, I'm actually building equity inside that policy that I'll be able to leverage. The difference between a HELOC in the life insurance, if I don't repay the loan, my family gets a reduced death benefit. My collateral is my dead self, not a building. It's my dead self. I've insured my dead self. So I get to use my dead self as collateral up to the amount of cash value whenever I want. There is no checking of income. There's no application to get the cash value to go use. There's no credit check. There's no credit reporting. It doesn't affect my credit score. It doesn't affect my ability to get a loan elsewhere because it's not reported. And the coolest part is I don't have monthly payments that I have to make back. So if I want to go flip a house in Wisconsin or in Tennessee, I don't want to do that debt service. Remember the loan payments on my mortgage is called debt service. Well, if I flip a house, I don't want to pay debt service. I want to buy the house. I want to put cash into the flip. And in 3-4 months, I want to sell that house for a profit. And I don't want to pay debt service for the 3 or 4 months while I'm fixing it up. I want the money to go to the house rehab, not the debt service. So I don't even have to pay the debt service. And historically speaking, the loan rates are much lower than what you'll see with HELOCs. And I've been doing this for like 13, 14 years now. I've seen loan rates change in the last one time, and that happened 18 months ago when the mortgage rates started going nuts. Loan rates on insurance went from like 4.4 to 5.4. That's it. And it only changes on an annual basis. It doesn't change daily like mortgage loans do. It's totally different. And here's the biggest takeaway of all of this. Because it's guaranteed to grow, my underlying asset is not going to get volatile. Because if this was the HELOC, if we go back to that other example, if I took the 100 grand on a HELOC, and what happens if the housing market drops? My underlying asset that I've leveraged, that I've borrowed against, has lost value. Why? Because the economy took a dump, because we don't know who's president right now, because there's an insurrection that they're not going to talk about. The economy tanks, my underlying asset can go down in value. That's when people get in trouble. I have a client, great dude, at one point was worth like $20 million. He basically got in early on a stock, IPO, went nuts, worth like 12 million, leveraged 8 million of that. So he borrowed against the 12, borrowed 8 million against the 12 to go do something else. Stock fraud was going on inside the company. Stock tanks to zero. They call the loan on the 8 million. He's broke. Now, he's done very well since. He's a smart guy, but all that money went down. So when we leverage other people's money, I don't want the underlying asset to be a depreciating asset like a car. I don't want debt equity in my home doing nothing for me other than just I'm debt free and broke. I would love to use other people's money to generate cash flow in a rental property. You better believe I'm not giving my kids money for a wedding. I'm going to let the insurance company give them money for a wedding. I'm so cheap. I'm not even going to give my kids money when I'm gone. I'm going to let the insurance company pay them millions tax-free into a trust. But I'm not using my money. I'm going to let the insurance company pay for it. And then when I retire, again, I'm going to borrow against my future dead self, generate cash flow off the radar screen of the IRS for income tax purposes. And I can collect Social Security. I could be on food stamps, living on a couple $100,000, $300,000, $400,000 a year. And from the government standard, I don't have anything on my 1040 tax return. I'm broke because it's off the radar screen. It's cash flow, tax exempt cash flow, not income. So here is the goal. When I earn income, put money into life insurance. I want to do all of these things. I want to start buying more and more cash flowing assets. They're going to generate cash flow that goes right back into my policies. Why do I want to do this? Because when I buy rental properties, and businesses are great too. Rental properties and business are two great things that I'm a fan of. When I do the rental properties, I get depreciation and deductions, which are different than putting money into a 401k, which is a deferral, not a deduction. I can actually have tangible assets, and the IRS will incentivize me to go buy this stuff through depreciating the asset and deducting the cost it took me to do it. Meanwhile, I'm getting cash flow that's paying me long before retirement years. All funded through my boring, guaranteed 130-year-old-year-old life insurance. 130 year old 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 life insurance. That's all I got, guys. That's all I got. I'm losing my voice. Great presentation. Very well said, Amir. Thank you for being here. I appreciate that feedback. Before you leave, let me show you guys something. Let me show you something before you guys hop off. I'm going to put in the chat box too. This conversation is very important. From $3 that are paid in the policy, $1 goes to death benefit, $1 cash value, $1 goes to surrender value. So it's easy to plan for the cash in the future. The cash will grow 6-10% average if you buy a policy. With time. Friend, you're exactly right. Friend, as a client, understands all of this. Robert, thank you so much, dude, for being here. Really quick before anybody logs off, check out this link that I shared. If you don't mind, go to this link. I've been working hard for the last year on writing a book, and it's finally done. It's going to be available next week. I'm doing a live launch on Zoom. It's going to be like a 15-minute call. I promise you I won't bore you, but if you show up, I'm going to give you some free goodies. I'm going to give you access to the financial course online, which might not interest you. But if you're like me, I like to buy a book just because of the nostalgic value to have it on the bookshelves. But I have a hard time reading it because I have 3 toddlers at home. Not a lot of free time, right, Jay? So I listen to audiobooks while I drive or while I'm working out. If you show up on the Zoom call, I'll give you access to the audiobook absolutely free. We're going to give away the Kindle book for 99 cents. And I'm going to have full transparency here. Amazon does this algorithm where if you sell a certain amount of books within a certain time frame, you go to bestseller. Well, every hour they check. So we're going to try to get everybody on this call at the same time. Everybody. Oh, you're right. I didn't put it on there. Now to everyone. There you go, Amir. I want everybody to get on this call and buy this Kindle, at least the Kindle for $1 at the same time, and hopefully it'll boost me to the Amazon bestseller, which I can leverage forever, which is gonna be awesome. And we're trying to get a TV spot here pretty soon as well, which I think would be kind of interesting. And Jay, you better believe that there's a hardcover, my friend. The soft cover is cheaper, hardcover, even with. So Amazon, you can't print with a jacket. It's just a hardcover, and the text is printed on the hardcover. If you go to Barnes and Noble, then you can buy the hardcover with the sleeve. But if you show up on Zoom on Tuesday, just get the Kindle to help me out. It's $1. I'll give you a free audiobook, which I'm recording now. That won't be done for a couple of weeks. But yeah, super stoked for the book launch. So thank you, everybody, for being here. Yes, Friday, Tuesday afternoon. And I texted Carlos about Friday, just so you know. Thank you so much for being here, everybody. If you're not part of the school, go into the school. Robert, you're the man, dude. Good to see you on here. Checking out school, all this free training stuff was on school. This is the first time I've done this presentation, which I really am kind of trying to sink my teeth into. I think it's pretty relevant. I think it talks a lot about like easy ways to change what we're doing, like buying cars and stuff like that. So thank you guys for being here. There's a couple of questions I'm going to answer now here too. Your contact info is Arthur. Arthur, go and join this, and you'll put some information on that too, and I can reach out to you directly, but you can message me on there as well. Yeah, this is cool. Should we keep doing Wednesdays? You guys like it? Should we keep doing one? Nice. I'm in. You probably will get bored. I'm not like an encyclopedia. I think what I'm going to probably do is really nail 3 or 4 presentations and then probably put those in rotation and then maybe spend a little bit of time on current events, but how deep is your knowledge on tax strategies? As you know, I'm about to become a realtor at some point. Excellent info. Thank you, Fran. Talk to you soon, Fran. Tyler, I am not a tax specialist. What you'll find is that most CPAs are actually historians, and they're probably what I would consider not tax specialists either. They're good at tax returns, not necessarily good at tax strategies. So to find someone looking out the windshield rather than the rear view mirror is difficult. There's a Facebook group that I joined It's called Tax Flow. I think it's Tax Flow Strategies on Facebook. That guy's pretty good. Thank you, Fran. Talk to you soon. But as a realtor, my friend, look, there's three ways the government incentivizes financial decisions: taking care of your family through life insurance, taking risk in starting a business, and helping people have a place to sleep at night or work during the day. Real estate. Those are the biggest places you're going to get true tax deductions. When you go from W-2 to 1099, it's a whole world difference of tax. You're now allowed to deduct your vehicle, your home office, like all of these things that you were going to do anyway. The government incentivizes you because you could say it's part of your business, as long as it's part of your business, right? But I'm not a tax specialist, so the guy that I'm referring to is local. He lives in Franklin, so hit me up and I'll introduce you to that guy. Word. All right, everybody. I will see you all Tuesday. Like I said, 15-minute Zoom call Tuesday. We just want everyone to buy at the same time, and let's go Amazon. Thank you for being here, and we'll see you all next week.